Welcome everyone to HueFin News. Today is March 22nd, 2019. The home of the 2-minute price prediction, as well as give me all the news according to the charts. This is a breaking news update that we want to share with you all. We did a video for the United States equities market on the 19th of March with a thumbnail asking, will Jerome Powell cause the equities markets to have a breakout to the upside? And currently, a lot of these analysts and individuals are in a panic at this particular time, trying to say that the market is going to enter a recession, mostly due to the 3-month and the 10-year bonds inverting of today. And that is one of the major indicators to indicate that we are on the cusp of entering a recession. So we're going to go ahead and give you all an update regarding what the price charts are insinuating regarding the news that is currently being seen on the media, videos, as well as on articles that you may come across. Okay. If this is your first time come to our channel, make sure that you all go ahead and continue to subscribe, like, and share, because we are the only place to where you are getting the news according to the charts, and we're giving you the perceptions of all the market participants, all of the analysts who delve into the financial markets, place their ideas on the price chart. So if you are able to understand what the price chart is literally telling you, you won't have to involve yourself with doing so much of that analysis and research. So this is what we're going to do. We're going to look at this article right here from Market Watch. Stocks tumble as the bond market flashes possible recession signal. See, that's one of the things you want to keep in mind, is that no one gets it right 100% of the time. So they have to give you some leeway, some exit strategy or pause in their articles to let you know that they said possible. Okay. Recession signal. This is written by Chris Matthews and William Watts. And it starts out with U.S. stocks fell sharply Friday after a downbeat round of microeconomic data in Europe and the United States raised global growth fears, while a closely watched yield curve inverted for the first time since 2007. That's 12 years ago, triggering recession worries. So this, for the most part, would be the pin that has popped today's momentum from continuing to see movement higher. This inversion that has occurred with the 3-month and the 10-year bond hasn't happened in 12 years, since 2007, and that's prior to the financial collapse that has hit the United States back in that particular time. So this will cause a lot of worry, because we're coming right back to what was experienced back in 2008. Okay. This is what the indexes are doing right now. You can see that the Dow is down almost 1.5%. Fell about 306 points. Right now it's down almost 400, 1.45%. And you can see that the S&P is down 1.58 as well. Fell off 33 points. And the NASDAQ is down almost 2%, down 113 points today in the market. So the S&P is down 1.5%, down 44.18 currently. And I continue to show you that a lot of fears has been stoked today, but we're going to look at the price chart to see really if that has been occurring. The fears were compounded when data showed growth in the United States manufacturing sector slowed to a 20-month low in March, almost 2 years. As equities came under pressure, investors bought bonds. This is what forced the inversion to occur between a 3-month treasury bill as well as the 10-year note. Okay, so this is what caused it, supposedly. A so-called yield curve inversion, where the rate of a longer dated debt falls beneath a shorter dated debt, is widely viewed as an accurate recession indicator. And the spread between a 3-month and a 10-year yields is the most closely followed by economists. So I thought that they was closely watching the 2-year treasury bonds versus the 10-year. But now they're trying to go on in this article and say it's the 3-month and the 10-year. Another problem that this article goes into is talking about U.S.-China trade relations. remain a concern. Trump is trying to go ahead and say that they're close to a deal with China, but then he warned a couple of days after that the tariffs that they have on China right now may remain even after a agreement for a substantial period of time. This is just to make sure that the Chinese comply with the terms of the trade agreement. What type of incentive does that give China to do a trade agreement with the United States if in fact they will just continue to hold the tariffs in place? This is what some of the analysts are saying about the market move today in the space. The bond market is driving the equity market today, said Randy Frederick. Today's weakness clearly has a lot to do with the yield curve as the 10-3 went negative. Talking about the 10-year and the 3 months. A series of worse than expected economic releases from Europe has sounded the alarm bell, not just for the bloc, the EU bloc, but also the global economy, by providing further evidence of a worldwide slowdown in economic activity. So these things have already been in the forefront prior to the beginning of 2019. I just love the fact how a lot of the pundits, a lot of the media tried to portray like this is something brand new, and this is the reason and cause as to why we're seeing the decrease to the downside today in the market. And that's not it at all, because the same indications of why they're saying that the market is moved to the downside today is what we experienced at the end of 2019. It doesn't make any sense for them to continually to try to stoke fears of investors to try to get them out of these particular indices. That's exactly what's going on. That's why we've seen the market in 2018 enter supposedly a correction territory or even a bear market. You can see right here in the month of December. This massive spread monthly bar indicated that the news that we're seeing in this article here we was talking about then. And you can tell the previous months following that in December we went ahead and recovered from it. So now they're trying to hit us with the same amount of news that we just went through into December of 2018. So don't fall for that. So what we're going to do, we're going to go ahead and look at what the market is trying to show us. Okay, the actual truth of the market. And we said that when Jerome Powell came out and said that he was going to hold rates steady, wasn't going to increase rates for 2019, we said that there was a probability of a sell the news opportunity. And we went ahead and given you all some support areas in the market for each of these three indexes. And that's what we're going to go through today to see, are we still clear of us holding those support areas? And the first one was with the NASDAQ. We said that 7,200 or even 7,000 points would be a very good area for the market to find support. Okay, so even though we're seeing some weakness coming into the market right now in the NASDAQ, the market can still continue its movement higher. We're just showing some minor stockpile coming in this particular space, and we told you that 7,500 points in that video was still a resistance area. So this is no cause for concern at this particular moment until we see the NASDAQ break below 7,200 or even 7,000 points is when the cause to worry needs to begin. The market participants is still anticipating more or less consolidation movement higher for 2019 in the NASDAQ. The daily price chart real quick, you can definitely tell that weakness is coming into space. So that's why I went ahead and identified 7,200 or even 7,000 points as a support area in the market for the NASDAQ. So keep your eyes on that, as we in fact do see weakness coming in this particular space. So the near-term movement in all three of these indices will be movement to the downside. So keep your eyes on those areas that we identified today and even in our previous video in the market. Now, let's take a look at the S&P 500. Okay, the S&P 500 is dispelling the same thing as well. In our video about Jerome Powell, we said that the S&P 500 can go to 2,800 or even 2,750 in order for us to maintain the ability to continue to move higher later on throughout 2019. Looking here at the weekly time frame for the S&P, the market definitely is indicating market weakness. So we are actually hitting that 2,800 point level right now in the S&P. So we're on the cusp of actually trying to find some support coming into the market. Looking how we look right now in the S&P 500 on the weekly time frame definitely instills that 2750 is going to be in play relatively soon for the S&P 500. So keep that in mind as well. Now, another thing that you want to see is that we're not getting a lot of volume in these indexes today. As you can see, the NASDAQ is getting a little bit more volume, but it's not to the point to where you understand that it is being induced with a lot of sellers to try to push this market down. Okay, so that is another thing to keep in mind as we're trading around these prices. So the S&P 500 is trading around 2,800 points right now. 2750 would be the next one. If we break 2750 to the downside, then yes, the market is still maintaining that consolidational trading range, and it is kind of formulating a head and shoulders pattern. Okay, so keep that in mind too. I know that a lot of technical analysts understand that a head and shoulders pattern is an indication of weakness. We definitely will need to see the market hold support in the S&P 500 right there at that 2,800 or even 2,750 price. Okay, now let's go look at the last one, which is the Dow. We said that support in the Dow can be around 25,500 or even 25,000 points going forward in order for us to reclaim higher prices throughout 2019. So we are testing all of those support areas today in the market for these three indexes. Okay, so look for that to occur ending today, going into next week, and we definitely need to keep our eyes on those support areas in each of these three indexes. Okay, so right now 25,500 is those support areas in the market for the Dow. I am expecting the current movement is giving us some weakness, so understand that those support areas that we identify in the market has to hold. If we are not able to hold those prices in which we identified, then recession becomes even more apparent or a more drastic movement to the downside. Okay, so let's take a look, see how the market pans out at the end of today's trading day, and if we're able to maintain support at those prices, then we live to see another day of a continuation of consolidation and movement higher throughout 2019. So it's that simple, easy, not causing any fears, just giving you the plain unbiased truth according to the price chart is what we do. Make sure you all go ahead and check out our website as well, HueFinancial.com. We place a lot of our indications of what we expect some of these indexes to do, commodities, equities, stocks, or even cryptocurrencies, forex as well, there on our website. Okay, so make sure you all maintain profitability, and let's just see how this market plays out over the next couple of days.